This slideshow was originally presented in 2005 at the Mises Institute's Summer University.
Hello, this is George Reisman. In the space of less than an hour, I'm going to try to give you an overview of my theory of profit and interest and some of its major applications. I view profit and interest as so closely connected that I will refer to them in my talk as profit/interest. One reason for this closeness of connection is that historically the words profit and interest have been used by different authors to describe essentially the same phenomenon, namely the difference between the value of products produced and the sum of the values of the means of production used up in producing them, i.e. their costs of production. The classical economists called this difference profit. Members of the Austrian school usually refer to it as originary interest. Almost all other economists proceed as though most of what businessmen and accountants regard as profit is in fact interest, even if they do not use the expression originary interest. Both the classical economists and the Austrian economists regard the rate of interest on loans, or loan interest, as being determined by the rate of profit or originary interest, and treat it as a part of profit or originary interest. I too hold this view and follow this practice. For these reasons, I talk of profit/interest. The best place to start is with a brief description and critique of the two current mainstream theories of profit-interest, namely the conventional time preference theory and the productivity theory. I say conventional time preference theory because my own, very different theory is also a time preference theory. Learning what's fundamentally wrong with these two theories will be the starting point for seeing what we need to do differently in order to get on the right track toward explaining profit-interest. Incidentally, I hope you'll forgive me if I sometimes have nothing to say beyond repeating the content of the slide. That's what happens when a slide says it all. In such cases, I hope that my intonation will add something. Let's start with the conventional time preference theory. It attempts to explain profit-interest as follows. Future goods are worth less than present goods of the same kind and quantity. Thus, for example, 10 apples to be available 1 year from now are worth less than 10 apples available now. They are equal in value to, say, only 9 present apples. Means of production are valued as future goods. Their value derives from the value of their products, but those products will not be available until the future. Accordingly, the totality of the means of producing 10 apples to be available 1 year from now is valued as 10 future apples, and thus has a value of only 9 present apples. However, the year passes, and when it does, means of production initially worth 9 present apples are physically transformed into the 10 apples, which are now 10 present apples. Profit-interest, according to the conventional time preference theory, is explained by the growth of 9 present apples into 10 present apples. Sometimes the idea is expressed by saying that means of production are purchased at a discount to the future value of their products, and that when the future arrives and becomes the present, the discount is shaken off. At that time, the means of production have become the product, and more lowly valued future goods have become more highly valued present goods. Now let's turn to the productivity theory. It attempts to explain profit-interest in this way, and here I use the very same example that Bombaverick related in Capital and Interest. A primitive fisherman gathers 3 fish per day with his bare hands. If he reduced his consumption to 2 fish per day for 100 days, and saved 1 fish per day during that time, he would accumulate a stock of 100 fish. 100 fish would be sufficient to support his labor for 50 days, in which time he could construct a boat and net. With the boat and net, he could catch 30 fish per day instead of only 3 fish per day, i.e. 27 extra fish per day. If the bota net lasts for 100 days, the fisherman is enabled to produce an additional 2,700 fish. He gains 2,700 extra fish at the price of the temporary sacrifice of 150 fish, the fish he could have gathered if he had not constructed the bota net, a profit of 2,550 fish. In case you're wondering how a primitive fisherman could preserve fish over a span of 150 days, the example can be modified to avoid this problem. By supposing that the fisherman contents himself with catching just 2 fish per day for 150 days, while devoting a third of his labor each day to constructing the bota net. But this, of course, is an unimportant detail. The essential idea is 2,700 extra fish are gained at the expense of the temporary sacrifice of 150 fish, and that the net physical gain of 2,550 fish is supposedly a basis for explaining the existence of profit interest. Paul Samuelson says of exactly this kind of example, quote, "In the most general sense, this yield, more future consumption in return for foregone present consumption, is the return on capital." End quote. Samuelson's endorsement is a good indication of the popularity of the productivity theory, since he makes this statement in what has probably been the world's most popular economics textbook. The time preference theory and the productivity theory are often viewed as mutually exclusive alternatives. Nevertheless, there is a major common element that the two theories share. Namely, both of them view profit interest, which is an excess of money received over money expended, as explainable on the basis of a physical surplus of consumers' goods. For example, a net gain of 1 present apple, a net gain of 2,550 fish. It is very important that everyone realize that in order for either of these explanations to hold up, it must be assumed that the monetary value of a present apple will be the same next year as it is this year, and that the monetary value of a fish will be the same even though 10 times as many fish are being produced. In order for this to be possible, that is, in order for these prices to be unchanged, there must be an unstated assumption made by these two mainstream theories. That assumption is that the quantity of money and volume of spending in the economic system somehow automatically grows to keep pace with any increase in the overall supply of consumers' goods over time. Only if that assumption is made can their prices be assumed to be unchanged. Both of the mainstream theories break down over this point. It is the reef on which they shatter. Specifically, the formulas of both mainstream theories break down as explanations of profit interest in terms of money if the assumption is made that the quantity of money and overall volume of spending in the economic system is unchanged. If there is no increase in the quantity of money and volume of spending in the economic system, the production of 10 times the fish, or better, 10 times the supply of consumers' goods in general, would result in prices being reduced to 1/10 of their initial level, and thus in no additional monetary profit interest whatever coming into existence. I substitute consumers' goods in general for fish because if one talked seriously about the effect of a major increase in the supply of something like fish, the odds are that the sales revenues of that industry would plunge, because the demand for such a good is likely to be highly inelastic. The result of the plunge in sales revenues would be a plunge in the profitability of the industry. It would produce more, but earn less. Indeed, it would probably incur substantial losses. But when we talk of the supply of consumers' goods in general, we can assume a demand curve of unit elasticity, that is, one in which the change in prices is in inverse proportion to the change in quantity supplied. Such an aggregate demand curve follows from the assumption that the quantity of money and volume of spending in the economic system is unchanged. The same point about a fall in price applies to the time preference theory. The formula of the time preference theory implies that if means of production worth 9 units of present goods could somehow produce 20 units of future goods to be available in a year, the rate of profit interest should be as 11 to 9. But if the substitution of 20 units of future goods for 10 is the result of a doubling of the supply of future goods and a corresponding halving of their prices, the actual rate of profit interest will be no greater than before. The role of an increase in the quantity of money in the determination of the money rate, the so-called nominal rate of profit and interest, needs to be made explicit. Both the time preference and productivity theories implicitly take for granted an increase in the quantity of money and volume of spending commensurate with increases in the supply of consumers' goods. 2 or 10 times the goods will bring in 2 or 10 times the money, but only if there is 2 or 10 times the amount of money spent to buy goods in the economic system. And that requires at least a very substantial increase in the money supply. An increase in the money supply that sometimes may be sufficient, even though it is less than in proportion to the necessary increase in spending, and that sometimes may need to be more than in proportion to the necessary increase in spending to be sufficient. Just how much more money there needs to be will depend on the demand for money for holding. But the time preference and productivity theories do not explicitly credit an increase in the quantity of money and volume of spending with any actual role in determining the rate of profit and interest in terms of money. They take it for granted, ignore it, and simply credit time preference or productivity, their preferred explanations, as though it were they, and not the increase in the quantity of money and volume of spending, that was essential to the money rate of return. We need to recognize the role of the increase in the quantity of money and volume of spending in order to have a valid explanation of the money rate of profit interest. We have to recognize that the increase in the quantity of money and volume of spending is the actual cause of a substantial portion of profit interest in terms of money. Until now, its influence has been acknowledged only in periods of inflation, when its effect has been recognized as, quote, overstating profits. But in fact it is present almost always, and would be present even under the purest gold standard. This recognition can be taken as the starting point of my own theory of profit interest. The reason that a monetary component in the rate of profit and interest is present even under a gold standard is that the 1, 2, or 3% annual increase in the quantity of money that would occur under a gold standard would operate to raise sales revenues over time, and thus to systematically widen the spread between sales revenues and the earlier expenditures that show up as costs, thereby adding to the rate of profit interest. This addition to the rate of profit interest would exist alongside falling prices to the extent that the increase in the production and supply of goods took place more rapidly than the increase in the quantity of money and volume of spending. It should be noted that this elevation of the rate of profit interest argues against calling the gold standard and falling prices due to increased production deflation, which is a very significant finding in itself. We'll go beyond the monetary component in just a moment, but first it should never be forgotten that the increase in the quantity of money and volume of spending, not differences between supplies of consumers' goods at different points in time, is an actual determinant of the rate of profit interest expressed in money. It explains a difference between the amount of money taken in selling products and the amount of money previously expended in producing those products. The sales proceeds are going to be larger than the expenditures previously made to bring in those proceeds, in part for the very simple reason that there is more money and spending in the system when the sales are made than there was in the past when the expenditures were made that now show up as costs to be deducted from the sales. To identify other, more fundamental determinants of the rate of profit interest, it is necessary to put increases in the quantity of money and volume of spending aside, and assume that the quantity of money and volume of spending in the economic system are fixed. I call this fixity of money and spending invariable money. Conducting economic analysis in the framework of the assumption of an invariable money is the next step in my theory of profit interest. As soon as we assume the existence of an invariable money, a major problem may seem to arise. calling into question the very possibility of the existence of an excess of sales proceeds over costs of production in the economic system as a whole. The problem arises because of the following considerations. Taken in the aggregate, business firms are the source of their own sales revenues. Outlays for capital goods are sales revenues to the sellers of capital goods. For example, General Motors' purchase of steel sheet is sales revenues to U.S. Steel. Wage payments are the principal source of sales revenues to the sellers of consumers' goods. For example, wages paid by GM and U.S. Steel are the source of sales revenues to grocers and other sellers of consumers' goods. The problem that arises is that costs must seemingly equal sales revenues. This is because outlays for capital goods and labor also result in costs of production equal to those outlays. And in fact, if the aggregate outlays for means of production were the same year after year, for assets of the same life, annual costs of production in the economic system would tend to equal those outlays. This seems to imply that if expenditures for means of production were the only source of business sales revenues and costs, being equal to the same thing, would be equal to each other, and thus that no aggregate profit interest would exist. A positive average rate of profit or interest would thus appear to be impossible. So long as expenditure for the means of production exceeds costs of production, sales revenues equal to the expenditure for the means of production exceed those same costs, and aggregate profit interest exists. This aggregate profit interest equals an increase in the value of the assets of business, that is, net investment. Net investment results from the fact that expenditures for means of production add to the value of business firms' assets, while costs subtract from it. An excess of additions over subtractions represents a net increase, net investment. Happily, it can at least be shown that the elimination of profit interest can be postponed, more or less indefinitely. This is because the equalization of expenditure for means of production and the cost deducted from sales revenues can be postponed so long as what we Austrians call a lengthening of the period of production can take place, which is practically indefinitely. For example, the same sum of money annually spent in the purchase of equipment with a 3-year life will be accompanied by equivalent annual depreciation costs in 3 years. To the extent that expenditure for equipment shifted to equipment with a longer life, say 10 or 20 years, the equalization of expenditure and depreciation costs would take correspondingly longer. There are other examples, such as in connection with buildings, inventories, and construction projects. The basic principle is that a lengthening of the period of production entails a deferral of costs further into the future. However, there would be a problem if profit interest had to correspond to net investment alone. This is the fact that if the only source of profit interest were net investment, the rate of profit interest would have to progressively fall. This is because net investment adds to the accumulated amount of capital invested, which implies that next year net investment must be proportionately larger if the rate of profit is not to fall. Indeed, it would have to grow from year to year at a compound rate. For example, 100 of net investment, providing 100 of profit interest on a capital of 1,000 this year, would mean that next year accumulated capital would be 1,100, requiring 110 of net investment to maintain the same rate of profit interest, and then 121 on a capital of 1,210. But remember, under an invariable money, with no sources of sales revenues but expenditure for the means of production, expenditure for the means of production cannot grow. This means that any growth in net investment would have to be the result of a decline in total business costs, resulting from further lengthening of the period of production. That lengthening and the accompanying deferral of costs would have to go on at a compound rate. It would not be too many years before costs would have to become zero and then a negative number, which is simply impossible. But as soon as costs stop falling, the growth of accumulated capital, accompanied by an unchanged amount of net investment, implies a falling rate of profit interest. It should be kept in mind that in the long run, the continuation of any net investment whatever under an invariable money implies a repeated lengthening of the period of production. For example, an unchanged annual expenditure to construct buildings with a depreciable life of 40 years will be matched by equivalent annual depreciation charges in 40 years. Costs are continually tending to catch up with expenditure for means of production of any given life. Fortunately, there is another cause of aggregate profit interest that can be identified under an invariable money, and that does not imply any fall in the rate of profit interest, and that is operative alongside of net investment and if and when net investment is zero. This second cause of aggregate profit interest I call net consumption. It is the most important aspect of my theory of profit interest. In an economy with an invariable money, it would ultimately be the sole source and determinant of aggregate profit interest. And as I will explain, I regard it as the link that connects time preference to the rate of profit interest. To understand net consumption, we need to realize that in addition to the expenditures for capital goods and labor, there is a further source of business sales revenues over and above the expenditure for means of production by business. This is the consumption expenditure of businessmen and capitalists themselves. Their consumption expenditure constitutes sales revenues to the sellers of consumers' goods, but does not have any counterpart in the costs of business firms. It is financed by such means as dividend payments to stockholders and by draw payments to partners and sole proprietors. Such payments do not show up as costs of production. They are a transfer of funds from business firms to their owners. I call this consumption net consumption because it is consumption in excess of wage payments. It is consumption net of wage payments. In an economy with an invariable money, net consumption can be understood as bringing about the existence of profit interest in a way that is similar to net investment, namely by reducing the costs that business firms deduct from their unchanged aggregate sales revenues. Net investment reduces these costs by deferring them to the future. Net consumption reduces them by reducing expenditure for the means of production, and thus the point toward which costs are tending. Once it is the case that expenditure for means of production becomes less than expenditure for the products of business, costs can come to fully equal expenditure for the means of production, and profit interest will exist because sales revenues that exceed expenditure for the means of production will equally exceed costs that are equal to the expenditure for the means of production. Net consumption has existed since the origin of money, and in fact was larger relative to total expenditure for the products of business in the past than it is today. This is because the consumption expenditure of self-employed workers and farmers is a consumption expenditure of businessmen and capitalists, not wage earners. The activity of these groups relative to the economic system as a whole was larger in the past than it is today. Nevertheless, for illustrative purposes, we can imagine net consumption coming into being simply on the foundation of the capital that has been accumulated through years of net investment. Thus, there are numerous businessmen and capitalists who are now quite wealthy. They can afford to live for many years off their accumulated capitals. How much they will judge they can afford to consume depends on their time horizons. A capitalist whose time horizon extends 50 years into the future will judge that he can afford to consume 2% of his accumulated capital each year and have enough to maintain his standard of living for 50 years. Another capitalist, whose time horizon extends 25 years into the future, will judge that he can afford to consume 4% of his accumulated capital each year and have enough for 25 years. Of course, I am depicting a degree of regularity and arithmetical precision that will probably not often be found in actual life. Please take it as a rough approximation to things. Let us assume, for the sake of illustration, that taking all the capitalists together, the weighted average rate of net consumption turns out to be 3% per year. Understood this way, the average rate of net consumption prevailing in the economic system clearly reflects a form of time preference. Those whose time horizon extends to 25 years have a higher time preference than those whose time horizon extends to 50 years, and so on, until we reach those whose time horizon extends to no further than the next day or week. Net consumption operates on the rate of profit interest by reducing the expenditure for means of production. Some of the funds that up to now have been expended for capital goods and the payment of wages are used instead to pay dividends, or are simply withdrawn from firms by the partners or sole proprietors who own them, for the purpose of buying consumers' goods. Please note, the expenditure to buy capital goods is less, the expenditure to pay wages is less, and so too, as a result, is the consumption expenditure of wage earners. In the place of the expenditure for capital goods and the expenditure for consumers' goods by wage earners, there is now an expenditure for consumers' goods by businessmen and capitalists. The overall total expenditure for goods as such remains unchanged. We still have an invariable money. What is different now is that because the demand for means of production is less, it is only a question of time before costs too will be less. Costs will tend to equal the now lower expenditure for means of production. When they do, profit interest in the economic system, equal to net consumption, has come into existence. This is because sales revenues in the economic system exceed the expenditure for means of production by the amount of net consumption, and equivalently exceed costs equal to the expenditure for means of production. Whatever the weighted average rate of net consumption relative to accumulated capital, that is what the rate of profit interest will tend to equal, because an amount of profit interest equal to the amount of net consumption will have been generated. In an economy with an invariable money, this rate will serve as a barrier to further net investment. Any net investment that is made will need to be perceived as capable of reducing costs of production or increasing sales revenues to an extent at least commensurate with the rate of profit interest established by the rate of net consumption. I must stress as strongly as possible that what determines the rate of profit interest is the system-wide average rate of net consumption. No individual businessman or capitalist is capable of improving his rate of profit interest by consuming more. To the contrary, he will reduce the profit interest he earns because he will deplete his capital, which is his means of earning profit interest, to a far greater degree than he can possibly add to profits in the economic system. The profit interest he will contribute to by virtue of his own consumption is the profit interest earned by others, not by him. Much, much more needs to be said in support of the net consumption, net investment theory of profit interest. I've merely given you a brief overview. For the necessary elaboration and answers to many or most of the questions you may have concerning it, I hope you will read my book, Capitalism, A Treatise on Economics. I want to turn now, in rapid order, to simply naming a series of further important points that I think follow from an economic analysis based on the assumption of an invariable money, and hope that if you are interested in the actual demonstrations of these points, you will turn to capitalism to find them. They are all there, along with many more. Business in the aggregate is the source of a monetary demand for its products that is sufficient to enable it to operate at a positive rate of profit interest. No outside stimulus is necessary. Falling prices caused by increased production do not reduce the rate of profit interest or make the repayment of debt any more difficult. Capital accumulation does not require or cause a falling rate of profit interest. The relationship of saving to capital accumulation is as force to acceleration, not force to motion. Under an invariable money, one act of additional saving that serves to raise the demand for capital goods sufficiently relative to the demand for consumers' goods is capable of launching a process of continuing capital accumulation. Nominal net saving and nominal net investment would disappear in the long-run absence of increases in the quantity of money and volume of spending. Capital accumulation would take place to the accompaniment of falling prices of capital goods, with the same capital funds representing more capital goods. In the presence of continuing increases in the quantity of money, nominal net saving does not reduce the rate of profit interest, but takes place out of a rate of profit interest that is elevated by the increase in the quantity of money. The importance of saving exists at the level of gross saving, not net saving. Capital accumulation depends not only on gross saving, but also on anything that serves to increase production in general, such as technological progress, greater efficiency from any cause, a larger supply of labor, above all and most fundamentally on economic freedom. Government interference undermines capital accumulation by reducing the efficiency of production as well as by reducing gross saving. Real wages and the general standard of living rise from the side of improvements in production and falling prices, not from the side of rising money wages or other money incomes, and this is true even when the quantity of money and volume of spending increase. My analysis leads to the most radical overthrow of the Marxian exploitation theory. It shows that profits are not a deduction from wages, but wages and other costs are a deduction from sales revenues, which in the absence of capitalists and their expenditures for means of production would be all profit. My analysis also leads to the most radical overthrow of the Keynesian unemployment equilibrium doctrine, i.e. the IS curve and the MEC curve. It shows that in the context of recovery from a depression, the slope of these curves should actually be reversed. They should slope upward, not downward. This is because net investment and profits move together, virtually dollar for dollar. Thus, as economic recovery takes place and unemployment is eliminated, the rate of profit rises, not falls, with additional net investment. As I say, you can find the proof of all this and much more in my book, Capitalism. I thank you for your attention.
Please see this additional word from me.